You spot a clear break of support. You sell. And then the market shoots right back up, triggering your stop loss. These erratic reversals often happen when a trader misidentifies a minor price fluctuation as a major shift in the trend. We determine if a move is a major shift by measuring the depth of the discount. To be structurally valid, a pullback must reach at least the 40 to 50% Fibonacci zone. This depth ensures the market has retraced enough to attract a new wave of institutional orders, rather than just taking a brief pause. If price doesn't drop into that specific pocket, it hasn't gathered enough buy-side interest to build a true floor. Everything above that line is considered market noise. By mapping out only the swings that meet this retracement threshold, you stop reacting to the noise that institutional algorithms use to trap retail liquidity. Look at this sketched uptrend. The price makes a minor dip, pushes up slightly, and then sharply drops below that recent low. A common mistake is labeling this break a change of character and assuming the trend has reversed. Measuring that prior dip shows it failed to reach our 40% threshold, meaning it never hit the discount zone and wasn't a valid structural point. This invalid break is just a liquidity sweep, smart money triggering stop losses before moving up. Breaking an invalid low actually confirms that the current trend is gathering fuel to continue. To enter this uptrend, look for an order block, a zone of heavy institutional buying, positioned below an open fair value gap. But placing a limit order is risky. Wait to see price tap the gap and print a strong bullish candle as confirmation. As the trend matures, price pulls back deeply into the 50% zone, creating a verified swing low. It bounces, then crashes through that validated low. Breaking a foundation backed by a significant retracement creates a true change of character. The uptrend is over. Let's test this. On this new chart, price pulls back slightly, then breaks lower. Is this a liquidity sweep or a trend reversal? The shallow pullback missed the 40% mark, making the low invalid. Therefore, this downward break is just a liquidity sweep. Trend changes only occur when the market has enough momentum to break through a swing that met our specific retracement criteria. Before looking for entries, you need to see the macro boundaries. We mark the absolute high and low of the previous day. These levels act as primary targets. Lower timeframe movements are usually just price traveling between these two zones of liquidity. Follow 3 operational rules. Rule 1. A swing is invalid if the pullback fails to reach the 40 to 50% Fibonacci zone. Rule 2. If price breaks an invalid swing, it is a trap designed to collect liquidity before the trend resumes. Rule 3. Every order block entry requires a fair value gap and confirmation of institutional presence. Success in chart reading comes from using this specific checklist to separate high-probability swings from the noise of the market.